Welcome to our module on capital cities versus regional areas for property investment. This module is designed for first home buyers, property investors, and investors. Today we're going to talk about the difference between capital cities and regional areas when it comes to property investment. This is motivated by, a common dilemma for investors, which is whether they should compromise and buy in a cheaper area, that might be a regional area, if they can't afford to buy into a capital city, or wait and build up their deposit to buy into a capital city. What we're going to talk about are the differences between these markets and how they perform, why their yields are different, what this means for investors and who these properties might be appropriate for, and then compare their cycles. So first of all, let's start with capital cities. So we can talk in Australia about some really strong capital cities like Sydney and Melbourne, for example. These are cities that have major international appeal and bring in a lot of immigration every year. Because of this, there is always a demand for housing, which keeps consistent price growth over time. Obviously, these markets work in cycles, which we'll talk more about at the end of this video, and this performance also creates the opportunities for investment. Regional areas, for example, don't have the same robust continual supply of international immigration. So as a result, property prices and rental prices behave very differently. The markets here are not as robust and consistent in a way, which we will, of course, break down further. But how is this translated in their yields? So remembering, yield is comparing the rental price of a property to its actual value. In capital cities, we tend to see low yields, which is basically meaning that the rents will be low in comparison to the value of the property. Properties, obviously in capital cities, are more expensive. Whereas in regional areas, you'll see that rents will be higher in comparison to the price of the property. Now, what does this come down to? It basically comes down to the demand for properties, buying them, versus the demand for renting in those places. Because remembering that property values are driven by owner-occupier demand for that property. That is, the demand for people to buy a property to live in. So we see continual strong international demand. There's a lot of glamour and prestige to certain suburbs in Sydney and Melbourne, for example, and other capital cities. Whereas to rent in these areas, the rental growth will have a ceiling, because after a certain point, to rent at a certain expense, someone might as well buy a property and own an asset. So that's why that rental growth is capped. You'll see much tighter yields then, lower yields in, say, the CBD than you'll see in suburban areas of Sydney. In contrast, we don't see that same compression because the demand isn't as strong in regional areas. So breaking this down further and what it means for property investors and people to take advantage of these different markets. What you'll find in capital cities is the more consistent growth over time and growth prospects. So because these cycles tend to behave, as we talk about in other modules, Sydney normally performs by going up or flatlining or leveling out and slightly correcting, but it very rarely goes too far down. So it basically means that regardless of what time you buy into that market, long term, if you're able to stay in the market long term, you're going to see growth in your portfolio. Regional areas don't have the same continual movement in that sort of cycle pattern. So it means that you have to be more selective about when you enter a cycle in a regional area. Now, going back to those yields for a second, obviously the implications of those yields for investors are very different. Because the rent is lower in comparison to the property price in a capital city, it's a lot harder to hold on to these properties, meaning that it's more expensive week to week to own those properties with the mortgage and expenses of the property, the maintenance, the council rates, land tax, etc. Whereas in regional areas where you've got higher yields, you might actually have better chances of getting positive cash flow or positive gearing, which means that you'll be able to meet the expenses and then have a profit on the rent. So obviously that sort of property is a lot easier to hold. Whereas with the capital cities, buying them might be one thing, but then holding on to them might be another proposition altogether. So obviously it's a lot easier for people with lots of disposable income, high salaries to own properties in capital cities and use them as investments, because they'll be able to hold them and meet those expenses long term. Even if they're negatively geared and taking a bit out of their paycheck every week, they'll still be able to do that and live a comfortable lifestyle in the meantime. Whereas in a regional area, you're more likely to find properties with higher yields that are easier to hold on to. So that's really the basic difference and major implication for different people. You'll still see growth in a lot of regional areas, but you've got to be a lot more selective about when you buy into those markets because those cycles behave very differently. Again, going back to that capital city scenario, the growth is a lot more consistent over time. Even if there's going to be downward moments, overall it will tend to trend up because land appreciates over time. We're not making any more of it, but there will be like population growth to continue to drive that, and that's safely predicted into the future. So breaking it down, obviously the picture is a lot more straightforward that people who can buy in capital cities because that growth is a lot more robust. For people who are tossing up or thinking about buying in a cheaper area in Sydney versus a regional area, the thing you've got to think about is it may not make that much sense to be negatively geared on a property that's really far from a lot of infrastructure, that's far from any CBD or urban centre, not close to jobs, and the things we talk about in the other modules that make a good investment property. And it also doesn't make sense to not buy in at all if investing is a worthwhile tool for you to reach certain lifestyle goals. So you're better off maybe looking at a regional or interstate opportunity that you can comfortably hold, because it doesn't make much sense to buy an investment property that you're not going to be able to hold for the long term, because that's where you're going to see the value. So it comes down to a simple picture at the end of the day, but which one's appropriate for you will always depend on timing and your individual circumstances, your capacity to hold that property. Thank you very much. If you need more clarity, you can reach out or check out the other modules for more information in and around this area. Hello everyone, thanks for tuning in to the Sydney Listings Academy. Just a quick disclaimer that this advice is generic and is not to be used by individuals. We take no liability for misuse of this information and encourage you to seek out professional advice specific to your situation. Please reach out to get in touch with our network of trusted professionals if you so need it. And just before you take off, just a quick note, obviously we're working on something with the Sydney Listings Academy to help educate people about the potential in property, finance and investing. So if you want to support the Sydney Listings Academy, please share the content with friends, family and followers if you have them, and also follow Sydney Listings on Facebook, Instagram, LinkedIn and or YouTube, wherever you like to hang out, as well as our website, and check that out for more resources as well. Thank you very much guys, and we'll see you in the next video.